Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today we are discussing the 18-year land cycle and how you can use it as a framework to understand the best macro markets at a macro level. So what state or metro city to invest in based off history and the 18-year land cycle. So a bit of housekeeping. By no means this is not financial advice. I'm not a financial advisor. This is my story. This is how I am seeing the markets play out. This is how I am looking to take action and invest personally. If this resonates with you, I'll put my details in the comments below. Feel free to hit me up. Happy to work with you from a buyer's agent perspective to source investment grade property. So we'll go through the 18-year land cycle first, and then I'll show you how I then overlay it on certain markets to best understand where we sit within those markets and which market to select moving forward based off how they have performed over the last 20 years. So if you have followed me so far, the 18-year land cycle, I use it to manage my investments from a property perspective, from my stocks, from my super that is currently invested in Australian shares, to manage my debt and cash levels, because there's always a time to buy in different markets. There's always a time to build. There's always a time to refinance cash up to protect your wealth and your portfolio. And there's also at times where it can be best to leverage up and buy as much as you can and grow. So if you want more detail and background around the 18-year land cycle, I've done a few other videos, check them out. But basically, there's an 18 to 20-year land cycle that have a pattern from the 1800, which consists of 14 years of expansion, 4 years of contraction, and the 14 years of expansion is interrupted with the mid-cycle slowdown. The last time we experienced mid-cycle slowdown was COVID from late 2019, early 2020 down to 2022. And we are now well away at the races through the land boom, heading towards the peak of the market in 2026. So I use this to best play my investments, to not only take advantage of the coming boom, but to also protect your wealth and be set up for buying when in the next land-driven downturn. So in the first half of the 14 years of expansion, first half of the cycle, Sydney and Melbourne historically outperform. And then from the second half of the cycle, Sydney and Melbourne pretty much top out in terms of values. People can't then keep affording to buy in those areas based off the earnings from people's wages. So that's why people then start decentralizing from Sydney and Melbourne and look into more affordable areas such as Brisbane, Perth, Adelaide, and Darwin and their respective regions. And that's when Brisbane, Perth, Adelaide, and Darwin then outperform in the second half of the cycle. To overlay that as well, in the second half of the cycle, there's a lot more credit being created through banks as banks are earning higher profit margins. That draws on people looking to invest more in property. That then boosts construction and development, hence why that then boosts commodities. So the commodity cycle then kicks into gear in the later half of the cycle. So that is why Brisbane, Perth, and Darwin also then outperform even throughout the next land-driven downturn, which I'll show you in the next few slides of the 20 years of history of how you can overlay this information in certain markets to understand where they're going to be potentially heading in the next coming years. So right now, I'm seeing good value in Brisbane, Perth, Adelaide, and Darwin for the next few years. Perth, Adelaide have really kicked into gear and they're well and truly in the upturn. Brisbane is at the early stages, probably a third way through the upturn. Darwin is only just starting. Sydney, Melbourne, they're pretty much topped out in terms of values and they're going to stagnate for the next few years until we go through the next land-driven downturn, and then they will then lead the next 18-year land cycle, which would commence around 2030. So for me personally, I am looking at Brisbane to continue to build my portfolio by way of acquisition, but also building now. I've got many sites in Brisbane and in the regions, Queensland region, so I'm looking to continue to add to my portfolio in that region to capitalize on the land boom. And then I'll sell off some assets that I can't develop at the peak of the market in around Brisbane, and then redeploy the gains into Melbourne and Sydney to capitalize on their growth expansion through the next real estate 18-year land cycle, which would commence in 2030. So basically, I'm deploying my investment capital into Brisbane. I'll then consolidate, sell off a bit, and then start redeploying into Sydney and Melbourne, and then go from there. Perth, Adelaide, I think those markets are pretty much too hot right now. I think they're almost becoming too competitive to get into those markets, especially in Perth. Houses sell within a couple of days, if not a week, which is pretty crazy. And I like to get into markets before they go too hot, because ultimately you want to try and get the properties for under bank value so you can recycle the equity relatively quickly to keep moving forward. If you're competing with the masses getting into a market that is going through a bull run, you'll most likely pay overs. Therefore, you'll be waiting longer periods of time to be able to wait for the market to do the heavy lifting to strip your equity out and then redeploy. So yes, I believe Perth and Adelaide will do well, but they are almost too hot for my liking. So I'm only focusing on Brisbane and even Darwin, as I'll show in the next few slides. And then in the coming years, post the market peak, I'll be then focusing on Sydney and Melbourne. So this is Sydney, 20 years. This is a suburb in Sydney. As an example, Western Sydney, about 20 minutes, half an hour from the CBD on a train line, inner ring, inner west Sydney. To give you an idea, this is 20 years of history of units in this specific suburb. So where we are now in 2024, the equivalent is 2004 based off history. So if we go back to the 18-year land cycle, 2002, 2003, 2004, which is where we are equivalently 20 years ago in the market. And the lead up from 2002 to 2007, we're looking at Sydney. So between 2004 and 2007, pretty much stagnated, went back a little bit. And then it wasn't until 2011-12, which was the start of the current cycle, where Sydney units then performed. So this is showing how Sydney performed in the first half of the current 18-year land cycle from around 2011, 2012 up to the peak of the market prior to the mid-cycle slowdown in 2018, 2019, before we went through COVID. And now it's been flat, stagnant. And then based off history, 2024, 2025, 2026, 2027, 28, 29, 30 will be when I am going to start deploying and looking to start gaining here, and then to capitalize on the upturn in the next cycle. So if we go back there again, so from 2002 to 7, pretty much stagnated and did not much Sydney. And then it really kicked into gear from 2012 to 2019. Sydney outperformed the other metro markets, which I'll show you in a moment. So that's Sydney. Similar to Melbourne units, we're here in 2024. The first half of the cycle, the second half of the cycle, so 2004 to 2007-8, pretty much flatlined. So we're equivalently here, so 2024 to 2027-28, Melbourne is most likely going to flatline. It's also backed by the yields down there are very low, 4%, 3-4%. So a leading indicator is rents rise, the higher rents get capitalized into a higher price. Rents aren't rising yet. So based off history, it's most likely going to be pretty stagnant and flat in Melbourne for the next few years. And then again, between 2010, 11, 12, which was the start of the current cycle, lead up to 2018, 2019, that's where Melbourne outperformed. So Melbourne, 2012, lead up into 2019. So Sydney, Melbourne performed the first half of the cycle. And then I'll show you now what it looks like for Brisbane, Perth, Adelaide, and Darwin of where we are heading. Melbourne, Brisbane. So the current cycle started in 2011-12. So between 2011-12, Brisbane pretty much went backwards in the first half of the cycle. But from say around 2022, it's starting to run. It isn't going gangbusters like Perth is yet, but it's on its way. So 2002, 2003, sorry, 2022, 2023 is now the equivalent of 2004 in 2024. So we're here. And based off history, from 2004 lead up into the peak of the market in 2007-8, where Brisbane outperformed in the second half of the cycle. So this is a good leading indicator to show that Brisbane is primed for growth over the next few years as people decentralize from Sydney and Melbourne because they've topped out and they're going to pretty much flatten out for the next few years. People are now deploying their capital and moving and migrating to Brisbane. So based off history, in the current cycle where we are now in 2024 is the equivalent of 2004. And in 2004 to 2007, Brisbane units went up more than 100%. So that is a good leading indicator to show that Brisbane is in a very good position. Obviously, you want to be cautious. You don't want to buy at the peak of the market in 2026, 27, 28, because you'll be holding it for a good 10 plus years in the first half of the cycle until you get to the second half of the cycle where then Brisbane outperforms. So Brisbane's primed for growth the next few years. Perth, same story. Perth also has the economy very dependent on the mining industry. The mining industry, as I said before, kicks into gear in the second half of the cycle. As it's a land boom, there's lots of construction and property development that draws on commodities. There's a lot of commodities in Perth and in the regions in Perth. Therefore, Perth really outperforms in the second half of the cycle. So from 2004 lead up into 2008, Perth units went from 150K mark up to 350K, so more than doubled. So that's a good leading indicator to show that where we are now in 2024 is equivalent of 2004. Perth is outperforming the other markets as well, just like Brisbane. and then it'll level out and pretty much be a bit more volatile in the first half of the cycle. So from 2009, 10, 11, 12, and then again rise up in 2015, where that's pushed by the mining boom. And then there's a big slowdown into 2020 and 2021, 2022. So first half of the cycle, it's pretty much up and down, but pretty much flatlined over a good 12, 13 years. But between 2004 and 2007, 8, that's when it had its significant growth. So that's where we are now, based off history, is in 2004 equivalent market. So where Perth is primed for growth as well. Adelaide, I put Adelaide houses because Adelaide's pretty much like a big regional town. If you're looking to invest in the regions, I suggest buying a house. Houses perform pretty well and steady in the regions. I suggest if you're looking at Adelaide, go for a house rather than a unit. Same again in the first half of the cycle, so 2011-12, pretty much flatline. Didn't do too much in Adelaide, and then from 2022, which we are now in the second half of the cycle, Adelaide's away at the races, and then continued up 2004, lead up into 2008-9. Not as strong and as aggressive as Brisbane and Perth. It's more of a more consistent, like the regions, investing in the regions. It's more stable and consistent growth. It's not as much of a boom bust metro market. The regions typically just tick along year on year, but you can see still that there is good, strong growth in the second half of the cycle versus the first half of the cycle for Adelaide. Darwin, I really like Darwin right now. As you can see, 2004 to 2011-12, even through the GFC, Darwin outperformed when all other markets were coming off. So Darwin's really primed for growth the next few years, and people really haven't caught on to it yet, in my opinion. Because from 2014, 15, it went backwards a good 30, 40% into 2020. It's made a bit of a recovery, but it's now also again coming off again. So Darwin is more of a, I would say, volatile market similar to Perth, as it's more dependent on the mining industry as well. But based off history, between 2004 and 2008, 9, even up to 2011-12, Darwin outperformed in the second half of the cycle, as did Perth. So Darwin is now also primed for growth. Anyway, thanks for watching. Hope you enjoyed that. As always, this is not financial advice, as I'm not a financial advisor. I can guarantee one thing: if you don't take action, you won't get anywhere. Catch you next time.